Hi, and welcome to Forex webinar number 3, Popular Trading Strategies. Now, for those of you who haven't seen my earlier Forex webinars yet, a little introduction. My name is Jelle Peters. I'm the writer of Forex for Ambitious Beginners, which is available in the Amazon store, among other places, both in paperback and for the Kindle. I'm a writer for financial media, and I frequently give webinars and seminars. Now, many of you have already bought the book, so if you have any questions about the quiz, or for instance, or some other things, simply go to forexforambitiousbeginners.com and I'll be happy to help you. Now, in this webinar, we're going to look at some popular trading strategies. Many other trading strategies come from these trading strategies. Trend trading, range trading, they're very general, very important strategies. So after this webinar, you will have a at least a very general idea about many of the popular trading strategies, what they are based on. Okay, let's quickly move on. Now, trend trading is perhaps the most important strategy that there is. It's based on a very simple assumption, namely that if there is a clearly identifiable direction in the price development of a financial instrument, this could be a currency pair or gold or oil or a stock, then there is a trend and we can profit from that direction. Now, this also means that by definition a trend should be easily recognizable. So this is a trend. This is a currency pair, Australian dollar, Japanese yen. You can easily see that this is an upward trend, and this is not a trend. Also very easily recognizable as being gibberish. Now, prices move sidewards, ranging much more often than they trend. The hypothesis for a trend trader is that when the trend is intact, it stays intact, and he places the stop loss based on the opposite idea. So that when beyond a certain point, the trend trader says, okay, now the trend is gone. For instance, if 20% of the direction has been given away, then you can say, okay, now the trend's gone. This also means that the trend trader often has to enter the market multiple times before catching the right wave, because he has a stop loss. So when he gets in and there's too much movement against him, he has to get out again. He doesn't want to risk a lot of money on those entries. What he wants is he wants to get in and then at the right moment and then stay in as long as possible. So this means that a trend trader has a lot of small losses and a couple of really big winners. For instance, in the early 2000s, gold came out of a bear market. People got in, but then there was already a lot of some profit. So people say, oh no, you should get out because otherwise you'll lose that money again. But the trend trader, the real trend trader, stays in then and rides as far as possible with that wave. And if you did with gold, then of course in the decade that followed, you made much more money. But it's hard. It's a nail-biting experience for many people, and it's really, to be honest, it's not for everyone. Maybe not for most, actually. Now, range trading is something else. This is putting on a position to profit from a temporary price range. So, if we look at the following chart for the Euro Swiss franc, you can see an ideal range trade situation, which is here. Here you can see there is a clear resistance. There's a clear resistance level. There is a clear support level, and in between the price keeps going back and forth. So you can profit from that multiple times. This obviously is not ideal for range trading. This chart here, because first we go up and then we go down for a longer period of time. This is the pound dollar. You could say maybe there's a trend reverser here, but in any case it's not a good range trade. Now, the thing about range trading, of course, is that you can only spot it after it's already in place for a while, because those resistance and support levels that we saw with the Euro Swiss franc first have to be formed. So they have to be hit and defend a couple of times So you can say, hey, this is a range. Now, as a range trader, you want to try and spot those range trades as fast as possible, of course, so you can get in. There are a couple of pointers they can give you that will help you identify them quicker. One is there is more chance for ranging prices after a period of volatility. After a period of volatility, prices generally settle down and they try to find a direction. So are we going to go with the bulls or are we going to go with the bears? And in that period, it often goes like this. It goes a little bit with the bulls, and then we're going to go with the bears. Bulls, bears, bulls, bears. So in that period, you can profit through range trading. Now, ranging is also more common with currency pairs that don't have a big interest difference, interest rate difference, that is. So, for instance, earlier we looked at the Australian dollar, Japanese yen. They have a big interest rate difference. Australian dollar has a high interest rate and the Japanese yen has a low interest rate. This is also why it's often used for another popular trading strategy we didn't have time to discuss here, which is called the carry trade, where you profit from the difference in the interest rate by buying Australian dollar, so you get interest rate on that, and selling the yen. Now, this also means that there is more of a chance of a general direction in the Australian dollar Japanese yen than there is, for instance, with the Swiss franc and the euro, who have very little difference in interest rate. Another thing that makes the Swiss franc and the euro range more, their currency pair that is because their economies are interdependent. Especially, the Swiss economy is dependent on the Eurozone economy. Now, the more interdependent economies of two currencies are, the bigger the chance of ranging. This is also logical because they're intertwined, their economies are intertwined. So if one of the economies goes bad, the other goes as well. So then there is not a lot of trending up or trending down, the relative values of these currencies against each other. No, they stay intact, so they are ranging. When setting up a range trade, you should look at a couple of things. First, you decide on your point of entry in advance. You don't go in ad hoc. You decide in advance at that point. When it reaches that point, I'll go in. The second is you should always set a stop loss, preferably also a profit target. This is something, by the way, that goes for basically almost every trading strategy, maybe with the exception of scalping. But really, if you're a beginning trader and you're going to range trade, always set a stop loss and always set a profit target. And the third is don't chase the breakout when your stop loss is hit. This is one of the most common mistakes made by range traders. They are in the range trade. The price breaks through the range. They think, now it's becoming a breakout. So they take that loss, but not really, because they immediately open a trade in the direction of the breakout. This is fooling yourself. This is really not wanting to take the loss on the range trade. And 9 times out of 10, you go into that trade half-heartedly, into the trade, and the breakout fails, and you'll be taken to the cleaners twice. So don't do that. Now, breakout trading is a very popular strategy with beginning traders. The reason is because it's very easy to understand. What it does is it says, okay, if a certain resistance or support level is broken, you take in a position in the direction of the breakout. Makes sense. Unfortunately, a lot of breakouts fail, so it's not the golden, the golden duck that you might want it to be. Here's an example of a successful breakout. There is, as you can see here, for a period there is a kind of a ranging thing going on, and then that big red candle breaks that range, and in this case the price really falls down. So you could have made a bundle with that, but it doesn't always go that way, trust me. Now, there are two kinds of breakouts. You have the continuation breakout and the reversal breakout. The continuation breakout simply moves in the same direction it was moving after a period of consolidation. So it's very simple. It looks like this. First, the price is going like this, for instance, in an uptrend. Then there's a period of consolidation, and then it breaks in the same direction. So it moves in the same direction, breakout. That is more common than the reversal breakout, because a real trend reversal is rare. It happens, but it's much rarer than a trend continuation. And a reversal breakout means the beginning of a real trend reversal. So there's actually a breakout in another direction, and it turns out that that direction is now the new trend. So to be completely honest about the breakout trading, most breakouts are false breakouts. Most breakouts fail. Now you can test a breakout by using secondary resistance and support levels. So what you do then is, okay, if it breaks this level that we were looking for, we're going to wait a while to see if it also breaks a second level. So it's kind of a confirmation of the breakout. Unfortunately, it also means that you have to stay out longer, which means that you will be, trading less breakouts, and you will also miss a part of the breakout if it turns out to be successful. You can also wait for confirmation of the breakout through role reversal, which means you wait until the breakout, if there's a period of retracement in the breakout, it comes back. For instance, if it breaks through the resistance, comes back to that same resistance point, which should now be support, because if it's a real breakout, it wouldn't go through it again. And if it doesn't, if the support holds, you can say, okay, now I'll take a position. Of course, not always in a successful breakout there is an actual retracement, so then you could be on the sidelines for nothing. Now, breakout fading is very popular also with experienced traders because it's based on the simple fact that most breakouts fail. So you take a position against the breakout. For instance, you open a position when the price action gets back below the former resistance or above the former support level. So what we just talked about earlier, the breakout, using the support to get confirmation that the breakout was real, but if it goes through it, you can say, okay, so it was a false breakout. Here we can see an example of fading the breakout. You see here a couple of points where the price action goes through the trend line, and then immediately you take in a position against the breakout. You could have made a lot of money with that trading here. Now, scalping as a final strategy is about keeping positions open only for a very short period with the goal of bagging small profits. It's very popular. The notion is very popular with beginning traders because it's very fast. And it seems very cool because there are no stop losses or profit targets, at least not very fixed. It's moment to moment. But don't let it fool you, because successful scalping traders are very, very disciplined and very experienced often. Just to give you an idea, it's you keep it open less than 2 minutes, and the profit target per position is between 1 and 5 pips net. So after the paying of the spread. Now, as said, it's not very suitable for beginning traders. One thing is it only gets interesting with bigger lot sizes, because if you only get 2 pips profit per trade on average, and you trade with pip sizes of lot sizes of 1,000 units, then the pip is 10 cents and you make 20 cents per trade. That's not very profitable, or lucrative, I should say. It also requires a lot of mental discipline and stress resistance, which for beginning traders also is not their strong suit usually. Now, most scalpers don't set stop loss because it takes too much time, so this is also something that's very difficult for beginning traders because they have difficulty with accepting their loss. Okay, so next time we're going to look at some fundamental analysis. We're going to look at fundamental analysis and its role in Forex trading. What is it? How do you interpret financial news? What are some of the most important economic data? How to trade economic news. Even if you're a technical trader, it's important to know at least a little bit about fundamental analysis because other traders use it as well. So be sure to tune in for this next Forex webinar. For now, goodbye and take care.